Kind of what I wanted to do first, just a quick introduction. I'm a long ways from home, and just want to give you a little bit of a background from where I come from. So I work for AgStar and lead our swine team there, and I'll get into that in a little bit. But you know, AgStar is part of the Farm Credit System. So there's 80-some associations across the United States, and we're one of those associations with a trade area that's really located in Mankato, Minnesota, and we cover Minnesota and part of Wisconsin. We've been fortunate, or I'm fortunate to work for a company that I think probably 20 years ago made the decision that they would finance and would work with and wanted to grow into the swine industry. So today, we've got some $2.5 billion loan volume or loan commitments in managed credits that we do just in the swine business. Now, we sell a good portion of that to other participating lenders around the country, most of them farm credit organizations as well, and that includes some that we buy from other associations, some of them in the room here. But certainly a focus from a leadership standpoint, and that's what it takes throughout the system in our organization to finance the pig business. Our current client base would include the majority of, I'd say, probably 75% of those, which would be the top 25 or 30 producers in the country. And as I introduce the team here a little bit that we have, that I work with every day, you know, we're very involved in the industry as a whole, hopefully in supporting what you do. I serve on the, as he mentioned, as Joel mentioned, some committees. I also have been representing you on the NPPC Board of Directors for the last 3 years. And I've got, a year and a couple months to serve yet, and then they'll kick me off. But it's been an honor to serve an industry that I've been really a part of for my entire life. And then Steve Malachowski, the second guy there, grew up raising pigs. He's been with AgStar for 20 years, grew up on a dairy and pig farm, really understands the pork industry. He, in fact, is covering for me today out in Washington, D.C. as part of the Farm Bill Task Force that group of ag, led by the NPPC, has put together. So there should be finishing up here today at least the first start on a Farm Bill, the 2018 Farm Bill. Daryl Timmermans, we had to bring in a couple younger guys because we're getting a little gray-haired. Daryl Timmermans joined our team about 2 years ago. Very talented. Grew up in Southwest Minnesota on a hog farm and a dairy or a hog and grain farm. Really a good guy. Smart. Of course, all these young guys are smart. A lot smarter than I ever was at that age. And then most recently, we brought Dusty Compart onto our team. He had done an internship with our team. Great guy. Again, just really smart. Comes from a swine family, if you know the Comparts at all or that name. And just recently has joined our team and really trying to work more with our core markets groups. And we've got him on some special projects, primarily around contract finishing. So that's kind of the team of relationship managers, if you will. And our goal, our strategy, our stated strategy is that we want to help our clients be the best producers in the world. Now, I know we don't deliver on that every day, but that's our charge. We have a conference call every 2 weeks on Monday morning, and that's what we talk about. What do we need to be working with our clients to make them better producers? This is really the folks that do the work in our shop. This is our credit team. These 6 individuals do nothing but work on swine credits and back us up. They write up the credits, they analyze the numbers, they monitor loan covenants and so on as we go forward. And the exception to that would be David Trum's on the end here, a young guy. We have him doing multiple of things that he's still kind of learning, so we have him do some grain deals as well. But primarily this group works on nothing but swine deals. And they look young, but lots of people look young to me anymore. But they, with the exception of David Trom's, these guys and gals, they've all been through a couple of swine cycles already. And a funny story of one of the gals there that's pictured, I won't mention her name because it might get back to her. She had started with us in one of the down cycles, and she'd been around analyzing the financials for probably 6 or 9 months, and she went to her boss at that time and said, I like the swine business, I like what we're doing, but do these guys ever make money? Are they ever profitable? So you really have to have that kind of a flavor around this industry to understand the cycles, and I think our crew does. So enough about us. This is kind of what I wanted to talk about today. I want to talk a little bit about pork, our supply and demand, and I think it'll be really, I think maybe eye-opening. I look at it a little bit different way maybe than an economist, and I notice you caught yourself. I am not an economist. I'm a pig guy that does lending. I talk a little bit about new pork processors. It's got to be on everybody's mind. We've never, in the time I've been in this industry, we've never had the number of new shackle spaces coming online. How does that impact you? And I wanted to talk about that a little bit. Kind of a global look at pork demand, and then really dig down into, because it really becomes about your farm's competitive position long term. What's the financial position? What's your cost of production relative to the rest of the industry? How does your revenue compare in the industry? And then how do you manage the risk? So that's kind of where I want to get to, so you know where I'm headed. And I think that's what's most important as we go forward. So, wow, that showed up big. Good. So looking at USDA reports, so there's been a lot of gyration. So if you look at USDA's December 1st Hogs and Pigs report, the amount of adjustments that have been done in past reports going, looking in arrears, really should cause you some concern. Does the USDA really understand and know what's going on out there and what's happening? And I think that as you look at, and I look at these numbers, and it's the column to the far right, and I look at the sow numbers and the inventory relative to numbers back in 13 where things were fairly normal before PEDV hit the Midwest, and we started adjusting for that. Because if you look at sow numbers December 1st of 14, December 1st of 15, some of those sows were loaded in facilities. Instead of running them at 98% capacity or 100% capacity, if we had room, we ran those sow herds at 104, 105% capacity for the fear of we were going to have another break of PEDV. Well, when that didn't happen, we started adjusting or rationalizing that sow herd back to normal. So you really look, I think if you look at 13 to 2016, you really look at the growth in the industry from a sow perspective. And I think that's been something short of 2% larger breeding herd by USDA numbers. It's 5.8% over 3 years, so about 2%. Our group, when we sit and talk about, our internal group at AgStar, when we sit and talk about sow growth, new farms that we know about, it's greater than that. Got quiet in here, didn't it? But what we don't see, so outside of southern Minnesota and western Wisconsin, what we don't see is what exits the industry. Barry, we don't have a clue. We don't call on those people. There could be folks leaving the industry, and I suspect there are some farms going dark, but not that many. So this is a little bit of concern, and I certainly think it's 2% or around that is what we're growing this herd from a sow herd number. Then, all you got to do is look at the numbers below, and we'll talk about productivity gains, but we all know that we're making those as well. So this is the breeding herd. If you go back to 93, we're just simply, we've reduced the sow herd. We're starting to grow it, as you can see. I was going to use this arrow one time. Is that the middle button? Or does that shut everything off? I'm good. You can see the kind of the growth here since December of 13 and coming back in terms of the breeding herd number according to the USDA, and I think we'll see further corrections as we go forward, and I think that's the point I'm trying to make is that we think it's just a tick higher than that in what we're actually growing. The other and just as big or nearly as big impact is productivity. Just in looking at pigs per litter, we're growing that at about a 1.5% per year and fairly steady, except for, as you can see, and unfortunately, the PEDV year. But certainly we continue that trend of more pigs per litter, and I don't think that'll change. Barry, you going to get more pigs next year? Yep. Yeah. It's going to continue to grow that way. So production, as you saw earlier, I think in some, we've got many systems that are 26 to 29 PSY, and pretty big systems that are doing 26 or 29 PSY. And I can tell you from 5 years ago, that's up 4 pigs. I mean, you saw the chart today, and it looks very similar amongst some of our, many of our clients. Not all, but many of them in that 26 to 29, and some significantly over 30, and some fairly good-sized production systems. So the genetics are there. I think for the most part, facilities are there. You know, so then it becomes, you know, it's really about, you know, management and health. And so if you can get those two right, you can continue to grow. The other point that I'd be remiss not to mention is pig survival. And I think we are making a big focus on that. Most of my clients in working on improving pig survival, and whether that's pre-weaning mortality, or I'm talking more importantly, or just as importantly, about wean to finish mortality. How do we get more pigs to grade A pigs or top pigs, however you name them? How do we get more pigs to the primary market? And I think people are focusing on it. We're getting it done, and so that target is moving up, in my estimation. You know, this is an industry that, you know, if you look at historically, and I don't think I'd have the numbers to back it up, but I would suspect that we probably market to our top market historically something like 90% of the pigs that are weaned. Maybe a little bit less than that, might be 88 to 90. There's a lot of room for improvement there. We've got systems that are doing 94 plus that are getting to the #1 market from weaning. And I think that, we'll get back to that here in a little bit. But so inventory, U.S. market inventory, again by USDA numbers, significant growth over that period of time. Same period of time from 93 on, we just continue to grow pig production in the U.S. And you can see the big changes in the years, the PEDV year. You go back here to 07, 08, who knows what that was, the big jump there. That's not all new sows and new production. That's circovirus, right? So we solved and fixed the circovirus issue to some degree and saw that kind of a jump. So if you put those two together, it gets kind of, it's a very telling story for this industry from a technology standpoint, from an efficiency standpoint, from a carbon footprint story, you know, all of those things that we can do and we have done, and we have done so much better, just producing a whole lot more with a lot less. And that's just pig inventory and sow numbers and a clear trend of where we've been and where we continue to go. So this just gives you a modern or up-to-date, a weekly look at where pigs are, where pig production on a weekly slaughter level has been. And you can see in the fourth quarter of last year, the yellow or gold line towards the right. You know, we hit 6 weeks that was over capacity, stated capacity here in the U.S. So any way that you look at it, we dodged a pretty big bullet here in the fourth quarter. And if you look at the next chart here, just looking at where we're going to go, this is based on USDA numbers of what was on the ground December 1 and what would be marketed, and that's the red line looking over the next 4 months, and that's what is expected to be marketed. Not going to push packer capacity unless something drastic happens to a packer, but certainly a lot of supply coming at us going forward. So you can, as I did in church a week before last, I think, the old guys sitting around the table that get there for 8 o'clock service at 7:15, and you know, they were talking about the paper the morning before, the Omaha paper says, you know, has this front page bacon shortage. I thought, that's awesome. That's what we need. We need this shortage of bacon. There just ain't going to be any. Better go buy it now. So I told those guys, you know, don't worry, you're going to have plenty of bacon. We got more pigs than we've ever had. We'll find the bacon for them, Tim, right? So what I try and chart is on a monthly basis kind of, and this is just a chart I put together based on USDA's production. So that's the blue line on the top, USDA production. You can see the big run up in the last 4 or 5 months production. We've had several record months of pork production. November and December were both record production all time in the U.S. But the bottom line is more important. That's what I would say is, that is domestic supply. So that adds the imports of pork, reduces the takes the exports from it, and then adjusts for what goes in and out of cold storage. And that's a more manageable line. It's still high, but it doesn't go off the charts. Still a big supply in the U.S., but I think as we have all been accustomed to understanding is that most of our expansion in the pork industry has been exported, right? So we've grown production, but we've exported it. And that speaks to that to some degree, but supply continues to grow to some degree. Now I want to switch gears, and this is why I'm going to make any disclaimer that I'm not an economist, because I think that's supply, and we talk about supply and demand, and I think we talk about it a lot like we know something, and I think we know nothing. What I would say is that if we had this meeting the end of December, the last week of December, we'd be sitting on pork bellies were trading about 94, somewhere in that ballpark, 94 cents. And we had record supplies of pigs then, still record supplies coming from a seasonal standpoint. And yet today, yesterday and today, pork bellies were trading over $1.80, double, almost double what they were at the end of December. That's demand that we don't understand, right? I mean, we just frankly don't get it. We don't understand it. We can't react to it. We can't until it's already happened. But it's very complex. You know, domestic demand is complex enough. And then we put on top of that international and export demand, which is very challenging. And then to top that off, we have, you know, what we deal with every day, most everybody in this room, is what's live hog demand, because that can be very different from pork demand. Domestic demand, I think the stuff we don't understand is, you know, consumer preferences. We understand a little bit about consuming meat, competing meats, relative prices of proteins at retail. You know, how does chicken compare? How does beef compare? How does that influence buying decisions? The U.S. economy and what disposable income is. And, you know, this has been a fairly sluggish recovery for 8 years or something like that, but the U.S. economy is not too bad. But how does that impact buying decisions day in and day out? And it's very hard to get a handle on that, except for some of the information you see is that retail prices being down, and they are, for pork, beef, especially beef, down for poultry. You see more, you see reduced price retail, more consumption on retail, and restaurants are hurting. I mean, that story is pretty relevant, but and plays well into the pork industry, right? We don't have the share at the restaurant, so when people are eating at home or buying at retail versus buying at a restaurant, it helps the pork industry. Export demand. Somebody talked about it earlier this morning, but to me, it's all really about access. We can talk about a lot of things in trade. The strength of the U.S. dollar certainly is important, especially against the peso, but look what's happened the last several months. We've got record U.S. dollar relative to the peso. Our pork is very expensive down there, and we're sending record amounts of it. It's about access. Competition from the EU. The EU is about 39% of the global export. That competition that was displaced from Russia is really what's challenged our exports to many countries we've relied upon. Japan, we dominated that market, we no longer do. We still sell a lot of pork to Japan, but we don't dominate it. The EU sells more pork there. Brazil's about 10%, Canada about 16%, US about 28% today. I think, you know, those things can change in pretty drastic order, for the good or the bad. Trump effect might have something, whatever that is. I think that's like the latest PERS or PEDV. It's the TE. It's the Trump effect. just the comments that he makes can make some change in that. But it's about, again, it's about access to those markets. And where we have access, we sell a lot of pork. A couple of things. Here's unknowns. This I just pulled off this morning. While I was listening astutely to the speakers before me, I was also trying to keep up with the daily news. And one of them was they had a new outbreak of foot and mouth disease in South Korea this week. Not good for South Korea. I think 2010 they had the last break there, and they destroyed a third of the herd, a third of their domestic herd. Now they've been vaccinated since then, so maybe the vet would say it shouldn't be near as drastic and they shouldn't have to go through that again, but certainly an impact from cleaning that up one more time, and it will impact exports there. The other one was discussion about easing some of the sanctions against Russia. Russia, 5 and 6 years ago, was the leading importer of meat around the world. Not pork, but meat. And we sent a lot of pork there. So if that impact could, this thing could get pretty crazy in the face of record numbers of pigs, just simply from that demand standpoint if something changes in that regard. So there's huge opportunities, also huge concerns, right? What does Trump do? What does he not do? How do other countries react? I just think they need to build that wall short enough that we can still get pork over it, and we'll be okay. So just another way to look at it, if you look historically at pork production, the blue line, and then domestically what we consume, the more kind of a purple line there, been relatively flat, but still growing in the purple line. So growing domestic demand for pork, not per capita though. That's been really flat, and that's the number you guys see a lot is per capita, but the population's grown over those 25 years. I like to watch this, although I'd caution everybody here. This is the blue line here. This is domestic retail, USDA retail scanner data for pork prices. So they do a survey every month of what pork is selling for at a retail level, and they report those prices. Now, I wouldn't say, so this would say we're backed off, pork prices have backed off to near $3.50 a pound on average. We all know that there's specials, there's a lot of other influences that are probably not captured in here, but it gives a good perception or a good idea of kind of where pigs are being, or where pork is being priced at a retail level. And then with more confidence, obviously, the wholesale pork value is the cutout value. The green line on the bottom is live net farm prices. And I think never before, I hesitate to say this, but you guys know it anyway. This has been record packer margins the last several months, back into last fall. Packer margins, if you look at this, the difference between the green line and the red line, have been very strong since 14. And that should cause us all some concern. And as you look at the challenges that we face with supply. So in other words, it should cause us some concern, but the issue really is around, the number one issue is around, in the fourth quarter when we're exceeding packer capacity 6 weeks out of those 13 weeks, you're not going to expect to get a bid, right? So that's an issue. But I think maybe there's a little more fundamental margin being played, and we'll get back to that a little bit. Competing meats, you look at the supply, and somebody mentioned it earlier, so I won't dwell on it much. You can see the pork's been relatively flat, but the big change has been the trade-off between beef and poultry growing, and that's been there's so many factors when it comes to beef that, it's drought, it's cost to gain, it's cost to meat. Beef is rebounding now with big supplies, so that's changing, and will take some time to catch up. But the one thing I've always said is, if you look at what pork tries to model, so cook it like a steak, Nothing wrong with that. I think that's good, but cook it like a steak. You now see, if you look close enough, not a lot of it's caught on, but pork sirloin, pork porterhouse, pork ribeye. Then you see all the time, you see turkey bacon, chicken sausage, chicken bacon, which, by the way, don't ever try that if you do. Please don't. You'll be sorry. But everybody's trying to, beef is the standard, right? So that's the way you want to look. But this is really, I think, the concern going forward. Can we consume the product that we're going to have left here domestically when you add it all up from a pork, beef, and poultry standpoint? Because it's rare where we have a couple of years back to back where poultry, beef, pork, turkey grow in production in the U.S. And they're all dependent on more exports. And we're having that right now. And we expect to have it again in 17. And so we get back to not what I would say are record levels of meat production, but certainly pretty rapid growth in what we're going to be expected to eat in the U.S. from a meat standpoint. So that will be a challenge for pricing going forward. Not good news, I know, but that's the reality of where we're at. Export demand, I'll talk a little bit about the history of growth in exports, talk a little bit about recent issues, and I've discussed a couple of them, but the Russian ban is a big one. The strong U.S. dollar really impacts us when it's changing, not so much when it's stable. Hopefully that won't run away from us. The EU has become very competitive in markets, and it's partly how they price their export pork versus domestic pork, something we don't do here in the U.S., and we don't do well. I think folks would find it illegal to do it here, but it's done regularly in the EU. And then what's the Trump effect? And then all of this kind of offset, and we have to watch, because they consume about 51% of the pork in the world, what happens in China. So you can look at our export growth over the years, and it's been a phenomenal story. But if you look at that pretty close, you look at the last 5 or 6 years, and we've been pretty flat. And that's a little bit concerning, because again, we're still growing production. We need to turn that tables, and as I said, it's market access, right? We've got to get market access to places in order to ship pork. And TPP would have really helped us, but it wouldn't have helped us in 17 probably. Would have helped us out in 20 and 22, so maybe that stuff gets renegotiated. This gets really noisy and really messy, but the purple line, you can see Mexico now just took off. Just blew through any chart that anybody ever had about exports of pork from the U.S. to Mexico. And Tim and I were having a conversation over lunch, and everybody that I've asked, and I've asked a lot of people that travel to Mexico that are actual economists, and know there's no storage to speak of in Mexico for pork or meat. So this product, it isn't like they're storing up product for a 3 or 4 month period where, well, the Trump effect, you know, I think that's just not happening. They may be exporting some of the product we're sending there, but this is likely one of two things, and most likely demand, but it's also filling the pipeline to some degree, but that's pretty small because, again, there's not a lot of storage in Mexico. China's a wild card and flips around a lot, but a great opportunity for us long term if we can get, again, that's an access issue. That's a political issue around, a lot of issues not related to our price of pork, our quality of pork relative to theirs. So this would be the biggest downer that I'll show you today. This is Chinese pork imports and goes through probably October or something, is kind of August, September, October would be the end of this chart. Tremendous amount of imports of pork into China. The unfortunate part is the purple line down here at the bottom, that's the U.S.'s share of that market. So the EU, Brazil, everybody but the U.S., and don't get me wrong, it was pretty good exports to China, as you see. A little bit goes a long ways. But we simply need to win in this marketplace if we're going to win in the global in the global marketplace. China is the global market. So I thought it was kind of interesting. You know, we need to grow and we need to gain that. We don't really have a trade agreement with China. I don't know that one is being worked on today, but certainly we need to have that access. Switching gears a little bit, new plants being, I said I'd talk about it a little bit. So the new plants that have been built, Rantoul expanded a year ago. Pleasant Hope completed their plant and opened this last summer. I think they hope to get to 3,000 head a day. They're not there yet. Windham, Minnesota, it depends on who you listen to, but 5,000 to 6,000 head is where they want to get to. Their original plan was to open in October of 2016. Then it was January 1st, then February 15th, and they're not open yet. And I don't know what the latest date is. It's a challenge to retool or rebuild a plant, and that's what they were doing there. That's an old cattle plant that they're redoing. But I'm confident it will open at some point. It might be a while, but I would guess sometime here this spring they'll be open. Coldwater and Sioux City, those two plants are virtually the same, but they've just stated their capacity a little bit different. They're the same plant. It's 10,000 head at an 8-hour shift, and it's 12,000 head at a 10-hour shift, however they want to state it, but they're the same plant in essence. Those both started about the same time. Both are kind of on target, or at least on target or a little ahead of target, and both are expected to have at least kill some pigs by August, and probably be running pretty good by next November, October, November, and so fourth quarter they should be up and rolling when we have an impact here. Prestige, I'm confident they'll get that plant built. They haven't moved any dirt yet, but the expectation is they will this spring. And that's in Wright County, Iowa. And again, same kind of a concept, single shift. It's 10,000 head a day. But these plants, excluding Prestige, I'll add it when they break ground, okay? But excluding them and assuming none of them double shift, that adds about 30,000 head of capacity, or about a 6.5% increase. And I think if you look at USDA numbers, you believe anything that I'm telling you, I think we'll be at 4.5% or 5% more pigs by next fall than we were last fall. And so we won't push capacity, but there's not going to be a big lag in capacity at these plants. We'll fill them up pretty close anyway. And the next year, I don't have a huge amount of concern. That gets too far out when you start talking about the fall of 2018, whether we keep expanding the sow base and growing pig numbers, but some of these plants will double shift, or are likely to double shift. But certainly from our standpoint and our clients and the folks that we work with, I would say this has really created a procurement shuffle, if you will. Pigs are moving around. There's demand from those packers where there's some displacement. They're looking for supply. And so that's an opportunity if you happen to have a contract that is expiring in the next 12 months or so. And so there's a lot of that. We see it every day and talk with clients about, you know, what they're looking for in a contract going forward, and what they need to get done. And so a lot of discussion around that end of it. From a business strategy standpoint, in my mind, it really comes back, and it's really not all about cost of production, but a lot of it is. You got to be competitive in this world. I think it was Tim Lula who said, the farms that do it best will be able to do more of it. And that makes a lot of sense. I mean, that's just the way it is. And it's about driving costs from the industry and doing it efficiently. Bigger doesn't mean always lower cost, but there's some advantages to scale, obviously. Right-sizing the company. Certainly there's a point where further growth doesn't make it more efficient or less cost or more competitive. Risk management, we'll talk about that a little bit, but certainly the risk management is a lot easier with low cost, and I'd say that's my understatement of the day. It's a lot easier to look at the market 6 months out if your costs are 64 cents than if they're 70 cents. It's just a whole lot easier to pull the trigger and hedge pigs, place options, do what you need to do. So I look at, and I have for years, decades I guess, this Iowa State model for production. And I think it's a good model if you understand how it's developed, and you really need to have that information. But this looks at monthly profit and loss, and you can see the cycles in the industry based on a model. And so the model says you're selling a pig every day at the 201 price. You're buying corn every day as that pig's being fed at the Iowa average corn price and meal, which obviously no one does that, so you understand it's a model. But I think a pretty good tracking mechanism, and it's very competitive. I think, years ago, before they kind of changed the model, updated the model, most of my producers that would track alongside this would say that their cost, they could beat the cost by $6 a head. Today, that's not true. It's very competitive. This, I'd say, is representative of the top 10% or the top 20% of this industry in terms of cost. So this looks at the same numbers or the same values, but looks at cost of production and the revenue per hundredweight. And I just bring this up as a start for a discussion around, you really need to understand where you're at. This is an easy way to do some comparisons of where you're at in terms of how am I selling against the 201? What's my price received relative to the 201 when I get to the end of the month, end of a quarter, whatever it is. So how am I marketing my pigs? Number two, how are my costs comparing, or how are they tracking? And keep in mind, this now is, in my opinion anyway, top 10 or top 20% of production in the country. So you need something like that to compare to. I know our group, we've started, I think now, 3 or 4. I think 4 peer groups where we have producers that have the ability to come in and talk about cost of production, how they're getting it done, and I really encourage it. It's been so valuable for those producers that are in that. Even if it's one-on-one, 2 or 3 of you, some of ours, we try to keep it at like 8 or 9 producers or less because you don't want the whole world knowing what you're doing. But I think it really has a tremendous amount of value. We can start talking about cost, and you can start talking about how you got there, what you're doing different that got you there. And so that's my spiel for that. I'm not looking to start more groups, but it's really valuable. Then you begin to have maybe some of the advantages that a pipestone system has, where they can compare farms, compare a lot of different growers. But you don't have that value if you have 1 farm or 2 farms. You can capture some of that value and understand how to drive cost. So this just looks at, this is 2016 average, and I'll get into some of our client-based numbers, but this is again the Iowa State model, looks at revenue per head in 2016, average on a live weight basis about 46 cents, feed costs about $27.60, non-feed, and then death loss is the way they separate it. Total cost, $47.47 a hundredweight on a live basis, and you can see that's pretty competitive. I'd say that it is top 10 or 20, and lost $1.75 a head based on that model. So if you look at, and we've tried to keep a consistent peer group together of our clients and put these numbers and compare them to the Iowa State model, and better yet, to compare them so we understand where the industry is as a whole. So, break even, you can see up towards the top, that's the Iowa State model, break even, and then ours is right, our clients are right below it. And then the reason I was on my phone is I was trying to get that updated this morning, so I did. Now bear with me for just a second. I'll see where I put it. And if I wrote it big enough, I don't have to get my reading glasses out. So cost, break-even Iowa State through the first 3 quarters of 16. Our numbers always lag because our customers don't send in they send in their December 31 numbers, January 31, and we haven't had a chance to get it done yet. But So Iowa State break even through the first 3 quarters was $47.90. Our clients were $51.50, and I've always wondered why ours are higher. I think because of how they buy corn ahead or price corn into the diet. So there might be some hedging gains or losses in that cost of production because of how they do their finances. So they just include the cost of corn as it is, hedged, unhedged, bin, storage, whatever it is, as it goes in. And so the difference is now like $3.50 a head, but the big difference here has been revenue. So the revenue difference between the two is like about $9 a head in revenue. So they're beating it on the revenue end of the standpoint, at least in 2016. But probably more importantly, and one of the things I want to make sure I leave you with is the strength of this industry. Financial strength of this industry is really, really stout. And you can see by quarter 3, this one is updated through the 3rd quarter of 2016. Owner equity is 72% amongst our client base, and that's GAAP. And for most of you probably understand that pretty well, but that's GAAP. So in other words, if I have a 10-year-old sow farm that I've done no real maintenance or upkeep or improvements to, I've got a 10-year-old sow farm. On that balance sheet that you see there, that might be worth 0. And when in reality, it's probably worth, I don't know, $1,200 a sow. So this is not a market base, this is GAAP. So 72% owner equity, working capital per sow, $1,380. Just to give you an idea, covenants that we would normally use would be something around $500 a sow, say, something like that. So these guys our client base has a great plenty of working capital and a war chest to go back to. Fixed debt per sow, you can see went up. That would be indicative of expansion, or maybe a little bit of restructuring some debt, possibly. Operating debt per pig, about $22. Profit and loss, $12.07, and cost per head of $139. So, and I just bring it up because the biggest number to me is the equity and working capital. So I don't think at any time in history has the industry, from the standpoint of, as we look at our clients, the industry's not ever been financially stronger. And that's after an average or fairly poor year in 16. This looks at our revolver balance, just the revolving lines of credit and the changes, and not a huge story there, except for they're very low. We have about 20% or a little less than 20% of the available revolver that is extended today. You can see the year end, so lots and lots of tax being pushed forward, but certainly very, very manageable. Working capital, debt levels. The fact is that, you know, I hear it a lot. Why don't you guys get this expansion to stop? And it's like, our clients don't need to ask us. They just go do it. They have the cash, and they'll just go do it. And so that's kind of the position where we're at. Difference makers in my mind. So what separates the best farms from the rest? And I think number one in my mind, percentage of pigs that are weaned, percentage of the pigs weaned that are marketed to the primary market. And I said it before, we got folks that can do 94, probably a few that can do 96%. So that's 96% of the pigs weaned that get to the primary market. But the difference in economics is way more than you'll ever drive by increasing a pig per sow per year or two even. That's the big difference to me. Feed efficiency, or however you look at it. Feed efficiency is so misleading anymore from our standpoint. You look at it and it's a meaningless number. So you got to get to something that is more, you know, it's not meaningless for your farm, obviously, but as you try to compare farms, because you don't know what the diet is. But we need to get to some kind of a standard there, and it's probably kcals per pound a gain. I don't know how we get to that so that you can compare. The way I do it is I look at wean to finish feed cost per pound a gain, and that's the banker's way out. That's not really You want to know about efficiency and not necessarily cost. Great. Pig cost at weaning, obviously critically important, PSY, and then grower space. And I see a lot of difference in our customer base and what their spend on grower space per pig marketed. And depends on how the structure is done, how it's paid off, how many finishers they own, how many they continue to pay full contract space for, and then obviously the performance of those pigs. And then risk management, and I'll kind of finish up with that. Outlook that I would have for this year, obviously greatly improved since December. Pig supply is 4%, 4.5% larger than in 16. Good domestic and a surge in export demand at the end of 2016 saved our butt again. And so can we keep that going? And that's the million-dollar question. And from my standpoint, is that a risk that you can afford to live with, or do you put some of that, lay some of that risk off while the opportunity is there? And that's a question that everyone needs to be asking, and probably, maybe not today, but in the next 45 days or 60 days. Considerable risk management allows our clients, I don't think if they looked over the last 10 years that they would say, I made money by hedging pigs or using options, or I don't think that folks would look at it that way, but I think they would say, I took some of the troughs out of this thing, and in other words, I made really good money in 12 and 13, and I gave it all back in 14 if I looked at the hedging in and of itself. I don't think you're going to beat the market, but you are going to take some of those troughs out and allow yourself to continue to maintain, working capital, if you're growing, to maintain and have the abilities for that growth. Expansion continues. We talked about that some. Packer margins have been exceptional. Can they continue to be that way? I looked out and I heard some information from a couple different people, and I thought, well, I got to do my own research. So I sat down one weekend and I pulled up the information that I could. So this is Iowa State model that you just saw, profitability for the last 13 years, and that's the orange part, and then the Packer margins, if you look at the blue part. And this is Packer margins as provided by Ron Plain that's managed that for a number of years. I think he's retired now, but he's still working, still doing stuff like this. So, but if you look at it, and like I said, you look at 14, 15, and 16 in the Packer margins in those periods of time, very, very strong. And in two different, very different years. Packer margins were quite strong in 2014 when pig supply was short the whole year, very short. Packer margins were very strong, as you might expect, in 16 when pig supplies were excessive or great pig supply. So there's fundamentally, in my mind, something much different about that. And the question you all have to ask yourself, and I can't answer it, does 2 or 3 new Packers change that game? One would say it does because there's going to be competition. The flip side of that is somebody who just bought stock in Hormel Foods yesterday expects the same returns that they've been getting, and that's the expectation that the leadership at Hormel is being driven to. So I'll leave that one alone from here, or else I'll get in trouble. So watch list to me, I'd say more pork production, more beef production, more chicken, more turkey, additional 2.9 billion pounds of pork of meat in 16, an additional 2.7 billion pounds of meat in 2017. That's a lot of mouths to feed, or that's a lot of meat to stuff in mouths. Exports are projected to grow at 1.4 billion pounds, so we've got to beat that. I mean, we've simply got to drive more exports of this pork. I'll finish with a little bit on risk management. I got 2 minutes or a couple minutes? Good. So really, it's a price discovery and risk management I think you kind of got to throw in together. And I would say, one, from a price discovery standpoint, You really need to back up a step. And how many producers in the room are folks that are with production systems that have something to do with marketing the pigs? I know a lot of you don't want to raise your hand. How many of you, keep your hand up, if in the last 14 days you negotiated, you or somebody on your team negotiated a sale of a pig that would end up in the negotiated market? I know you're yeah. That's our issue as we think about who's negotiating these pigs. And thankfully, Brian Stevens is negotiating yours. But I think the challenge that we have is nobody wants to do it. It's costly, especially nobody wants to do it in the fall of any year, especially like last year. It's a challenge to do. But I think the number I heard was 2.6% in 2016 of the pigs in this country that were sold were negotiated, showed up on the negotiated market. That's a paltry amount. And something has to be done, or number one, we lose that market. And that might not be, that in and of itself may not be that big of a deal. We can all go out and probably negotiate some percentage of the cutout value, some percentage of the futures maybe, something different. But how are we going to hedge if there's nobody trading on the other end? And I don't think that we tried to cut out futures, and that didn't work very well. How does it trade relative to history? That's very difficult and will be a big stumbling point if we don't keep this market alive. And I know nobody likes regulation, but maybe that's the only way to get it done. One of the final things I would say is I would encourage everybody to, as you think about risk management, to commit to a written risk management strategy. And I think that's important if there's more than one person involved in your business. And I've seen it too many times among my clients where they had they did a lot of hedging, they did a lot of options, they did direct contracts, and the ownership and the management were never on the same page when they go back at the end of the year and say, we left what on the table, or we did what? You need a written strategy. So what is it? What's our price strategy? Is it when are we going to execute? When are we going to look at it? Is it a percentage of historical? Is it something seasonal? Is it when it hits it on an annual number to some level? You simply got to have that and know that and have some kind of a written strategy. What products are we going to hedge or manage risk on? Hogs, corn, meal, DDGs, whatever. What are we going to do from that standpoint? And how are we going to figure the market bias in? So the only challenge I have, I think looking at a percentage of historical margins was a great way to get us thinking about bells and horns going off when you're at 80% of the historical market. But the bias, your own personal bias, still needs to calculate into that. Otherwise, you end up in 2014 hedging pigs way less than what you could have, simply because, as far as you can see, we're at historic high levels, but that doesn't necessarily mean it's the right time to hedge. Tools that will be employed, really describe how you're going to do it. Hedging, options, direct contracts, whatever that is, are all part of that written strategy. How will decisions be made? Or who's going to make them? When are we going to meet to discuss it? Who's going to execute it? And how are the decisions of when we're going to pull the trigger going to be done? And then how will success, and this is probably as important as the rest of it, how will success or failure be evaluated? How do we look back at the end of a quarter or a year and say, we met our targets, we met our goals, or we didn't? Extremely important to go forward. And I'll finish with this that you can't read, which is always a good idea. This is just simply one that I keep for myself. So it's nobody's farm in particular, but it says, just so as I pull out of the driveway in the morning or on a Monday, what's the opportunity to hedge profits and what's that look like over the next period of time? So this is 2-week periods. This is 12 months. To the far right, based on my fictitious ability to raise pigs, it's a $7.61 profit, but you can see there are different periods in there where I might think I should be pulling the trigger here, if that's in the fall, if that's in the spring, whatever that is. But certainly, you ought to have this for your farm and look at it at least every few days to say, should I be selling that pig today, or, you know, is there an opportunity there? And so it's easy to develop, and probably your broker's doing it for you today. So with that, I greatly appreciate your time, and it's an honor to be down here and speak with you today. And if we have time, I'll take questions. If not, I'll be around.
Yeah, let's thank Kent, Will, and we'll have time for a couple quick questions.
Okay.
So any questions for Kent?
All right, that was easy.
Yeah. Reactions. So as you look out to this next year, like with your crush sheet, where do you see, obviously the summer, you know, it's the typical trends that we often may run in. As you look out, and again, I won't call you an economist again,
Yep.
But as you look out, where do you see the opportunities that producers really need to be looking at on that sheet, whether that's on the profit or as we look to the end of the year with the negatives coming?
Yeah, and I think some of the opportunity is in blending some of those. So maybe you blend some summer with some fourth quarter sales so that you're not hedging losses. Maybe you take some options on these summer markets. I don't think the time is quite right. I'll be wrong tomorrow, but I don't think the time is quite there yet to pull the trigger on some of these with some of the enthusiasm we have in, say, the belly market and in the meat complex. So I think there'll be some opportunity, but certainly got to be watching it. And generally, you know, early February is not a good time to be hedging your summer and fourth quarter pigs anyway. That time usually is like in April. But I'd be watching this today to certainly take some advantage of some opportunity. I've got, you know, I would say our portfolio today, our loan portfolio today, the clients in there would be probably, I would say, as of today, they'd be probably 80 or 85% hedged through April. I would say the summer, maybe 40 or 50% hedged through the summer, and then probably 30 or 35% in the fourth quarter. So they're already putting fourth quarter hedges on. That may not be right. I mean, they might have been a little bit early pulling the trigger, but you know, just staying ahead of this and being able to hedge profits long term has been a great advantage for them, and I think they continue to do it and take those opportunities. You know, if the market goes up, they'll still pull more. They'll still hedge more. They'll double that coverage, at least in the out months.
Very good. All right, let's give Kent one more round of applause.
Thank you.